Welcome back to Trading Hour. Well, as promised, Siddharth Vora from Prabhudas Lilladher joins us now to discuss market fundamentals as well as his top sectoral picks. Thank you so much for joining us, Siddharth. Well, a very important day today, and remember, an even more important day tomorrow, given the fact that we will wake up to the news of the tariffs. So, going into that particular event, how are you positioning yourself? How are you analyzing the entire tariff impact and any portfolio changes you've made?
So I think currently in the markets, there could be 4 or 5 pockets or sectors which are slightly more vulnerable to the whole tariff policy. But the whole domestic focused market is quite shielded, right, in terms of demand, in terms of pricing, in terms of margins. So I think pharma, IT, electronics, some export jewelry, some auto ancillaries. Some of these pockets are more vulnerable, and as we go into the big event day, we don't have any pharma, any export electronic companies, any jewelry players which are export oriented, or any auto ancillary players which have a larger share of their revenue from global markets. Even the OEM players which have larger revenue from global markets, we don't own any of them. The only sort of pro-tariff or anti-tariff, let's see how it plays out tomorrow, exposure we do have right now is IT. We are slightly underweight IT, but we still maintain an exposure to the IT sector.
Yeah.
Please go on.
No, I'm saying you look at the quant models very, very carefully, and your models are suggesting that the Indian markets are ripe for a bounce back, and that's already happened. From the lows, we've rebounded. But
Right.
How strong could the rebound be? What are the indicators telling you?
So, there are 4 or 5 indicators that are flashing green right now. I think the note that we've released, I think it's 20, 25 days old now. But what the models are telling us is that the cyclical to non-cyclical sector spread is now in favor of cyclical sectors. So cyclical sectors should do much better, whether you talk about metals, cement, infrastructure, power, capital goods, defense. Some of the cyclical sectors are better positioned than, say, FMCG, pharma, IT. So I think from a sectoral perspective, that's definitely one signal we are getting, both at a market level and from a sector rotation level. 90% of the times, 1 year forward, this signal tells us that cyclical sectors will outperform non-cyclical sectors and markets will yield positive returns. So that's one signal. The other signal that is giving us a slightly positive indicator is the momentum and low volatility spread. So the momentum factor had corrected roughly 35% from its recent highs, and it's now at a level where it can suggest historical mean reversion. So historically, momentum has picked up after correcting to these levels. So we believe, again, with some mathematical probability, that momentum should outperform in the next 12 months as we go ahead. Also, it's important to know that market breadth in India had collapsed to a very, very high level. So I think market breadth was down to roughly 40%. So I think that's a very, very low number. And historically, markets have been in the oversold zone, or value buying has started happening in the markets whenever market breadth over a 6-month and 12-month basis has corrected to these levels. So I think it's important to see that markets were oversold. Positive fundamental and macro triggers were in place. Whether you talk about PMI numbers, whether you talk about the RBI liquidity action, the rate cuts, the tax cuts in the budget. So there were a lot of fundamental cues which were shaping positively. DXY is stabilizing. US bond yields are stable. So I think domestic focused issues are getting more resolved now. The whole valuation froth also. I'm not saying markets are cheap. Large caps are, I think, 10% trading at a 10% discount. Mid caps and small caps, which were trading at a 40% premium, are now trading at a 15% premium. So I think the froth in mid and small caps has come off. Large caps offer very fair valuations to enter. So I think domestic issues are more or less resolved. Global issues remain to be resolved. So I think from here on, the direction of the markets will be decided by global issues rather than domestic issues.
We get that. Siddharth, you spoke about domestic cyclicals, you spoke about commodities. Let's focus on two specific sectors. The first one, of course, being the cement pack. Do you feel margin pressures for this particular space is largely over? Price hikes haven't really come through, but so that is one sector. Q4 and FY26. How do you see that panning out? And do you feel that steel margins have made, or steel spreads have made a bottom as far as Q3 is concerned?
So I think the whole play on cement and metals, at least in our portfolio, is coming from the perspective that if you look at metals, it's a global commodity. And I think with China sort of recovering, with the stimulus packages announced in China and Chinese demand coming back, I think metals will do well both on the volume front and the pricing front. That's the broad play. And I think metals have underperformed over the last 2 to 3 years because of muted global demand and China being out of the whole economic stimulus play. And in terms of cement, I think it's mainly to do with all the infrastructure and government capex that we see panning out in India over the next 12 months. I think the margin situation is not going to change significantly. It's the volume uptick that we are more concerned with on the cement pack. Along with volume triggers, I think valuations were also reasonable. So the way our model picks stocks, it basically focuses on which sectors do we want to be in, given the relative risk reward in the market, where we feel cement is well positioned both from a valuation perspective, a growth perspective, and a volatility perspective. That was one thing. And the other thing is a broader portfolio flavor for the last, I think, 8 to 10 months has been stick to quality, stick to low volatility, and have a slightly large capish bias in the portfolio. So we continue to hold anywhere between 50 to 55% in large caps and roughly 45% odd in mid and small caps. The simple reason being large caps give you valuation comfort but are vulnerable to global cues. And mid and small caps don't have the valuation comfort, but are more resilient because they are more domestic focused. So overall, getting this balance in the portfolio in terms of size and sectors is quite critical.
Siddharth, thank you very much for joining in. Enjoy these conversations. Look forward to the next one. Get into a break. On the other side, we'll get you more on markets and individual stocks.